Welcome everyone to the Java workshop for Daniel Krug and Associates. Today's date is December 17th, 2020. The title of our presentation is Engineering a Goal-Oriented Portfolio. My name is Rocky Ispan. I'm the Chief Compliance Officer and Associate Wealth Manager at Daniel Krug and Associates. I will be joined by Daniel Krug, CEO and Senior Wealth Manager in this presentation. Before we get started, just a couple disclosures. This presentation is for informational and illustrative purposes only. It is not a solicitation and should not be considered investment or tax advice. Our agenda for today, we're going to be covering what is true wealth management, what wealth management means to us. We're going to talk about our investment consulting process, which includes the discovery meeting, investment strategy meeting, and ending with the portfolio development, where you really get into the engineering the portfolio and stress testing it to make sure it's going to do what you need it to do. It's good to see you. Welcome to our presentation. And what I'm going to do now is turn it over to Dan Krug and let him take us through what wealth management means to us.
Okay, thank you very much, Rocky, for that introduction. And what we're going to talk about right now is what is true wealth management. In other words, what does wealth management mean to us here at Daniel Krug and Associates? And how does it relate to our clients and their success? So we're going to take a really kind of a dive into what this is so you understand it and you can then kind of portray it to your friends. First of all, if you've been in our firm for any length of time, you've seen this diagram. And this diagram kind of represents the different facets of wealth management. But what we're going to do today is we're actually going to get into a formula of how wealth management works and a little bit of background on how we got to where we are. So first is, what is wealth management? Well, you know, there are 462,000 advisors in the US today. And of these advisors, we'll call them investment consultants. Some of them, probably a large portion of them, have either wealth manager on their business card, or you might see it a little bit here. So CEG Worldwide works with high net worth wealth managers. And they, in combination with AES Nation, have done real deep studies on what wealth managers actually do, what kind of tasks they perform for their clients. And in that, they decided to go and put together a study. And in this study, they took a large sampling of investment consultants, and the very first question they asked them in their poll was, are you an investment consultant or are you a wealth manager? So the study went on to ask the advisors a series of questions related to the task a wealth manager regularly performs. Now, if you performed a task on a regular basis, you'd answer the question yes. If not, you'd mark it no. Now, what kind of questions may come up on that? The questions might be something like, do you regularly sit down and strategize with estate planning attorneys for your clients? Or do you do tax mitigation strategies and work directly with a CPA to make sure the strategies can be properly implemented? These are the type of questions that might come up. And again, you either answer yes or no. Now, what they found at the end of the study, after all the questions were asked, is a little bit different than what that very first question produced as far as a percentage of people that felt that they were wealth managers. In other words, when asked the question of whether you're a wealth manager or an investment consultant, 78% of the advisors said that they were a wealth manager. Okay, interesting. Now, what was the percentage when they went through all the different questions that pertain to the tasks that a wealth manager did? Well, you might be shocked to think that that number is a little bit lower than what the average person said they were as a wealth manager. In other words, 78%. Well, the actual number of wealth managers was really closer to 6.6%. Now that's a pretty big dichotomy. So that begs the question, if the advisors aren't clear on what a wealth manager is, how's the average investor supposed to know? Well, that's a very good question. So what we did here at Daniel Krug and Associates is we actually developed a formula to be able to really show clients exactly what wealth management is. So here's how it goes. So wealth management equals investment consulting. Now, 100% of the advisors out there do investment consulting. Some do it better than others, but they all do it. Well, that's kind of where the line of demarcation is between investment consultants and wealth managers, because a wealth manager is also going to do advanced planning and relationship management. And we're going to get into both of these. So let's start with the advanced planning. Advanced planning starts with wealth enhancement. What is wealth enhancement? Well, first of all, wealth enhancement works with investment consulting. And how it works is that it develops strategies to increase the net rate of return to the client. In other words, how much can you keep in your pocket? Things like cash flow planning, things like tax mitigation strategies. These are big parts of wealth enhancement. We're trying to enhance the return to allow the client to keep more of the money themselves, and Uncle Sam gets a little bit less. So that's wealth enhancement. Let's go on to wealth transfer. Now, our clients have been very successful, just like you have been very successful. Now, when it comes to transitioning your estate from you to your heirs, most people want to make sure that it's done in the most efficient manner possible, and they want to make sure it's private. So wealth transfer takes into consideration your estate planning, how the assets are structured prior to the transition. These type items, if done correctly, can have a huge effect on making sure that your heirs get everything that you thought they were going to get. So that's wealth transfer. The next one is wealth protection. Wealth protection, oh my goodness. Again, you've worked very hard for everything that you have. The last thing that you want is to have everything you worked so hard for taken away from you unnecessarily and in a manner that could have been avoided. Now with wealth protection, they deal a lot with, now you're looking at liability coverage. Is it correct? Do you have the proper coverage so if you did get sued, you're going to be protected? It could have to do with life insurance. It could have to do with your home and auto, those type things. Making sure the coverage is the way it's supposed to be so you don't have anything taken away unnecessarily. Now, what's the next area? The next area is charitable giving. Again, our clients have been so successful that they want to be able to give back. So they've got a very high charitable inclination drive. They want to make sure that they can give back, but they want to do it in a smart manner. So about a third of our clients are charitably inclined and really want to be able to serve not just themselves, but other people to help them, give them a leg up as well. So that's the charitable giving part. Now, those four areas deal with the advanced planning. The next area is the relationship management. In other words, how do you bring everything together to make it work for our clients? Well, you start out with the client relationship management. This is where you get into educating your clients, making sure they really understand the strategies so they know that they know that they know what they're doing is actually going to work for them. It goes to coaching. In other words, when we have market cycles that go up and then they crash down, who's going to be there to coach the clients to stay on course to make sure they can hit that finish line and hit the goals that they want to hit? Well, that's where the coaching comes in. From there, you're dealing with expert team relationship management. Well, what are we talking about there? We're talking about risk managers, attorneys, CPAs, insurance agents, wealth managers, all working in concert for the client. So everybody's on the same page. That part is so critical because it's through that that each one of these areas of advanced planning can actually be properly executed. So there you have it in a nutshell. This is what we at Daniel Krug and Associates believe true wealth management is. Now that you know what wealth management means to us and how it can serve our clients, we're going to get into the different aspects that lead up to building a portfolio that meets your need.
Okay, Dan, I'm going to take it over from here and go into our investment strategy process. So what we'd like to do is kind of go through an overview of what the process looks like and then do a deep dive into building your investment strategy and building your portfolio. Then let's start with the investment strategy process. So this is a diagram of our internal process that we use here at Daniel Krug and Associates. We call it the client investment consulting process. And it's a circle, and the reason it's a circle is because it's a continuum. It never really ends because things change over time. And where it starts is with our discovery meeting. So on the right side of the circle here at the top, basically what our discovery meetings is trying to get a good understanding of your family, your goals, your values, and what resources you have that we need to know about to start constructing a plan for you. The next step after we gather that information is we go into the investment strategy meeting. And that's where we start evaluating your specific desires as far as a rate of return, what your risk tolerance is, downside threshold. We can explain a little bit what that is. And in a little bit here, I'm going to go into a little bit deeper dive on this. But it's really getting a good understanding of what type of investor you are. And from there, that's when we go to work in our office. And that's the portfolio development part of this diagram, where we really get into analyzing your investments, designing your portfolio, engineering and stress testing that portfolio. And we have a great tool here that we will give you a little bit more in-depth review of called Portfolio Engines that really helps us design things to meet what we learned in your discovery meeting and your investment strategy meeting, putting all that to customize a portfolio that's going to work for you. After that development process, we sit down with you in the implementation meeting, and that's where we present the strategy. We talk about any transfer of assets that have to take place, any modifications to the portfolio or rebalancing. What do we have to do now to get what you currently have in line with your investment strategy? And then after that, it's back to work for us internally in the office, because we've got to monitor portfolios, monitor the performance of portfolios. We evaluate managers. We are constantly watching and studying the markets and the economy. And all this is going on to make sure that what we design is going to keep you on track for achieving your goals. So a lot of work is done in portfolio management and the ongoing evaluation of the portfolios and the performance, the money managers, markets, and the economy. And then as we move forward, we have periodic reviews with our clients. And that's where we're sitting down and really looking at now, how specifically have you done over since the last time we met. So we report on the performance. We talk to you about life changes, what's going on in your life that may impact those goals, those values, your family, or your resources that we initially talked about. And then we get into things like if there's been changes in estate or tax laws. Has there been changes in the financial industry or the economy and markets and things like that? What are all those potential impacts that can change or need us to modify or update the strategy that we initially started with? And if there are changes, and many times there are, we start the process over. We do a little bit updating of the discovery. What's changed in your family? What's changed in your goals and your values? Have your resources changed? And then getting into, has your desired rate of return changed or risk tolerance? Think of somebody that was working but now going into retirement. These things can change. So we want to constantly be evaluating and modifying the investment strategy to make sure that as things change in your life, we are keeping up with a plan to meet those challenges. So now we're going to take a little bit of a deeper dive and to explain to you what we do in the discovery meeting and literally what is an output or a tool that we have to gather and quantify the information. So we're going to focus here on discovery meetings, and what you can see here is what we call our mind map. And what a mind map basically is trying to get everything that we can understand about you, to get a holistic picture of you and your family on one page. And it starts with the top right corner here where you're talking about values. What are your values? We want to write those down. What are your goals in life? We want to make sure that everything we design is lining up with your goals and your values. What interests do you have? Because you're going to need your financial plan to be able to support the things you like to do, not just what you have to do. And then we look at your current team of advisors here at the bottom right hand of this page. Who are you currently working with? Are there any gaps? Do we need to bring in somebody that maybe can help us out, a CPA or an attorney, to achieve some of these goals that you have in your life? Then we move over to relationships. We really want to know who is important to you. Are there people that you're taking care of? Are you going to have to take care of parents as they get older? Things like that. Are you going to maybe have an inheritance? And who do you want to take care of if something happens to you? So we really want to understand these relationships in your family and friends and things like that, and how it lines up with your goals and values. Then we talk a little bit and get a better understanding of how you process information. I mean, it's really important that whenever we bring something to you, that you can understand it, you can digest it. Some people are very, very detailed and want charts and graphs and want the data behind decisions and recommendations, and we can provide that. Other people are more high level. Hey, just kind of give me an overview of the program, and that's good enough for me. So we want to be able to present things in a way that you can understand it, digest it, and make good financial decisions based off of the information and recommendations you're getting. And then finally, as we talked about before, what are those resources that you have that you are starting to work with? What assets, what liabilities, what incomes, right? What expenses? So we want to really get our arms around financially what's going on. And putting it all on this mind map makes it so much easier to see. And we always have this to go back to and say, is this still what represents you guys? Or are there changes? Another simple mind map we make is what we call a wealth map. And what it really gets into is more of what are the things we want to accomplish to grow your wealth over time. And if you start on the upper left side, you can see the investment consulting there. What's the strategy? What are the goals from an investment standpoint? And then we move over to the right side where, okay, we've kind of got some goals and an investment strategy. How can we enhance those? That's the wealth enhancement strategy. What types of strategies can we use that'll actually boost and make that plan a little bit more efficient? And then you drop down to wealth transfer. What do you want to have in place if something were to happen to you? How would you want your spouse taken care of, or your children? How does this, play out for your family ultimately down the road when you have to transition the estate to the heirs? So we want to get that all spelled out. And then moving over to the left side on the bottom, we get into charitable giving. Do you have charities that you're interested in supporting or creating a charitable plan? We can get into that. And then ultimately, if we've got a good solid plan, what can come against it? And that's the wealth protection area you see in the middle of the left side there. What could derail your plan and keep you from achieving your goals or protecting your family throughout this process? And then when you look at the right top part of this screen, you see a key. And that key gets into being able to identify those activities that are a priority, or it may be a priority that's completed, or if it's in green, it's completed. Yellow means it's in progress. Blue means it's deferred. You might not need to be working on something immediately, but we don't want to lose track of it, so we can defer it out to a future date or year as we're moving forward and working on creating wealth for you over time. So those are kind of the basic tools that come out of the discovery meeting. So the next meeting that we have after we've got a good understanding of you is what we call our investment strategy meeting. And in that investment strategy meeting is where we start getting a better understanding of what type of investor you are. And we all know that the purpose for an investment strategy meeting is really to determine the portfolio allocations that will maximize your circle of wealth relative to your goals. And we start with understanding the market. You know, we know that the market moves in cycles. The market goes up, the market goes down. But what we learn is as we study stocks, as we study companies, as we study industries and sectors in the market, and we study the economy, we find that there's a relationship in stocks as far as their volatility, the way they go up and they go down, and an average kind of rate of return that can be expected over time based off of the type of company, the type of volatility, which is measured in standard deviation, and what actually is the low end. You know, we've had some market crashes, and we know how those companies and industries respond when the bottom falls out. So every industry, every company may have a different bottom based off of their balance sheets and things like that. But we can develop an actual picture, and this is kind of what it looks like, of an individual stock, of a business, of a sector in the market, an industry. And over time, you get a good feel of what an average rate of return is with the amount of volatility that can be expected to achieve that rate of return. And that's the research we do. And not only do we do that for companies, but we've got to understand that in relationship to you as the investor. It tells us what kind of investor you are. What type of rate of return are you expecting? You know, how much volatility can you understand and work with without having to feel like I got to get out of this portfolio? And if you understand what the low end threshold of your portfolio is, if we don't breach that, there's no reason to jump ship, right? Because we've communicated upfront what your portfolio is going to look like and what the amount of volatility and downside threshold of that portfolio can be. So we're trying to establish, you know, are you conservative, moderate, or an aggressive investor, and how that plays into your expectations in your portfolio. And as we round that out, and in this investment strategy meeting, we get a good feel and establish what we call your family benchmark. And that family benchmark is the overriding financial parameters that we're going to work within to help you achieve your goals, but also let you know as we're going through reviews of this, hey, are we staying in line with our expected rate of return? Are we staying in line with the amount of volatility we're seeing? And are we actually hitting those benchmarks over time? And then this is kind of the one page we put together that kind of summarizes the results of that investment strategy meeting. You know, we want to identify what your true purpose for money is, you know, and that's the thing beyond the value of the money itself. And everybody's got a more subjective purpose for their money. You know, is it to bring security? You know, is it to bring independence, an inheritance, a legacy, things like that? And then on the left side, you can see your investment strategy objectives. We lay those out. What are we wanting to do with our overall objective? And then on the right side, it's the detailed investment objectives. What type of risk tolerance are you? Are you conservative, moderate, aggressive? We establish a benchmark for every client that allows that, an independent benchmark that allows the client to see, hey, am I tracking to my benchmark, or where am I in relationship to a benchmark with my portfolio? Your overall objective, your time horizon that you're going to be invested, what your long-term rate of return expectation is, and standard deviation and downside threshold. So this information, as we put this together with your mind map and your wealth map, now we can go into that real deep dive portfolio development process that we do internally to customize the portfolio to meet your needs. But before we jump into portfolio development, I just want to give kind of an overview of what types of investments and strategies we employ when we're developing that portfolio for you. And that's what this section is about. Again, it's the beginning of portfolio development, is to really understand what tools we have available and how we utilize them. And we kind of broke investing into 3 sections. We call it our Investing Evolved. And here you can kind of see the first section. It's called Core Markets, and it gives you exposure to what we call core markets. Why is it in the portfolio? Because it allows you to participate in economic growth. What is it? It's basically your broad market exposure, mainly utilizing stocks and bonds. And again, this is what most people are familiar with. Most of the time when you go to an investment or a financial planner or advisor, they're focused on just this one area, getting you exposure to companies in the S&P, the Dow, the NASDAQ, things like that, to the bond markets. And what you can expect with that type of investing is that the performance of those portfolios will rise and fall with the markets. Now, why is that a good thing to have in your portfolio, some core market exposure? Because we do know over time, economies do grow, and your core market exposure will give you a nice return, that standard stock and bond portfolio. But what we've learned over time is how to enhance that. And so we've got a couple other areas that we focus in on to enhance that core market exposure. And that's getting into tactical strategies. So kind of core market is a little bit more passive investing. It's performance that will rise and fall with the markets. But tactical is now, what are we trying to do to either enhance the return, or do we want some downside protection? Think of somebody, again, going from working into retirement. They're more concerned a lot of times in retirement with losing a lot of money than trying to make a lot of money. They just want to have decent growth with some downside protection. Limit loss focus strategies can give you that downside protection through discrete signals that are used within those portfolios to mitigate when a market starts going down. They have signals to sell those portfolios off and cut those losses on the downside. Conversely, an enhanced return focused portfolio is looking for the opportunities that are out there that can actually beat the index. And this year, 2020 was a perfect example of why tactical strategies can enhance your rate of return. Think of this, that what happened with COVID and the stock market in March when it dropped. We had a market crash March of this year. But guess what? Not all companies went down. The S&P went down, but literally some companies in the S&P started right back going up, but others stayed down. Look at the difference between an Amazon, a Walmart, Krug, Costco, companies that were allowed to stay open during the pandemic versus those that had to close. What happened to the airline industry? You know, Delta, United. Delta stock went down 87%. And those core market strategies just kind of float with those averages, where an enhanced return focus can give us some ability to say, hey, we don't want to carry all those companies. There's a reason why we're going to pick some and leave others out of the portfolio. And that's what enhanced focus is trying to do is to give you that little bit of upside protection or growth opportunity moving forward based off of what's going on in the world and in the economies of the world. So, and the last section is what we call diversifying strategies. And this is where we actually get into equity alternatives, and you can be in private placement, managed futures, taking long and short positions against a core market portfolio. And again, this is there to try to provide reduce some volatility, but it can lag equity exposure all over long periods of time. Again, these are protection kind of strategies. And then finally, bond and bond alternative strategies that are out there. They're designed to give you lower volatility. It's also going to give you a lower rate of return over time, but you don't have to worry about seeing your accounts going up and down that much. So we're trying to manage equity risk with a bond side of the portfolio that will mitigate that as equity markets tend to be much more volatile. So we build around core markets, but we add in the tactical strategies, the diversifying strategies to reach your long-term goals, whether it's growth, income, or protection. We can create a combination that will meet those needs that we're trying to put into your customized portfolio. And we have many companies that we use that are specialists in providing specific portfolios with those goals in mind. And so we create a custom portfolio for you based off of a combination of many different investment strategists that will overall bring you that overall portfolio performance that you're looking for. I hope you got something out of that. This is just the first half of portfolio development. I'm going to turn it over to Dan, where he's going to deep dive into engineering and stress testing the portfolio.
Okay, now we're going to get into some deep dive into portfolio engineering. And this is really what a lot of clients would like to know. How do we actually develop the portfolio structures the way we do to do all our wealth enhancement to allow the client to actually end up with more in their pocket? And we're going to talk directly at that. Let's talk about where we are on our continuum here. Rocky talked about the discovery meeting. He talked about investment strategy meeting and how we decide and really kind of pull out of our clients what is most important to them when it comes to investing. Then he got into the first half of the portfolio development from the internal side. Now, what I'm going to talk about really gets into the engineering of the portfolio and the stress testing of the portfolio. So let me lay the groundwork, the foundation here. What we do when a client has decided to come on board and we find that there is just this real good fit, we feel we can make a material difference for this client, at that stage, we take the current portfolio that they have from wherever they're coming from, whether it be another broker or another financial planner, or they did it themselves. But what we do is we take their portfolio and we enter it into a program called Portfolio Engines. And Portfolio Engines is very, very dynamic. It allows us to really do stress testing as we put this portfolio together to make sure that we're following those parameters set forth in the investment strategy meeting. So when you look at this screen here, this is a typical screen in Portfolio Engines. And what I'm going to set up here is we've got a individual coming on board who is a moderate investor. They currently have 3 portfolios, and if you look on the left-hand side, you'll see that you've got 3 portfolios. One's a New Frontier portfolio, profile risk 3. Now keep in mind that the risk profiles run from 1 all the way up to 6, 6 being the most aggressive. Then in the second portfolio, it's an SSGA profile 3, again, another moderate portfolio. And then the third portfolio is a Wyndham Profile 3. Now, it's not uncommon that when a client comes to us, if they're a moderate investor, that they would actually have all of their portfolios set up moderate. That's very common. Could be a conservative client, could be aggressive, but it's not uncommon that all the portfolios kind of look the same. They may have different assets in it, but the risk profile is the same. So the first thing that we do is we want to stress test that portfolio. We want to understand, how does it perform in a down market? How does it perform in an up market? So the next part, when you're looking at this slide, right in the center of the slide is a stress test. And in this stress test, we can actually take and make a determination, sliding the bar from a negative position all the way to a positive position. In this case, what we're showing is what would happen if the S&P 500 actually had a 41% correction. How would this portfolio respond? Now, right below that slide bar, you see the change in investment of this portfolio. As a moderate portfolio, you wouldn't expect it to go down 41% because it's not aggressive. And we all know the S&P 500 is all equity, so it's an aggressive portfolio. Now, let's take this a little step further. This client has a portfolio of $1 million, and it's divided up in each one of the portfolios 38, 29, and 33%, equaling 100%. Now, further, the New Frontier portfolio is a Roth portfolio. That portfolio is fully tax-free. That's probably the most valuable portfolio everybody has. Why? Because they don't have to pay any taxes on the growth. That's a good thing. What about the second one? The second one's an IRA. That one is fully taxable, okay? We know that every dollar that grows in there is going to be taxed eventually when it gets pulled out. Then the third one, the third portfolio, is a trust account or a non-qualified portfolio, what we would consider to be tax favored. In other words, you're dealing with capital gains and dividends as opposed to ordinary income like you will with an IRA. So 3 different tax statuses for these portfolios, but they're all invested moderately. And as you can see, the portfolio performance on the downside, the Roth went down a little bit more, the IRA even heavier losses, and then the trust account not quite as much. But we can see how this is performing. Now, what about if the market is going up? So let's take a look at that. Well, if we slide the bar to a 25% gain in the S&P 500, how does the portfolio perform? Well, again, in this case, it's up 14%. All right, that's not bad for a moderate portfolio. Again, you wouldn't expect it to be up as much as the S&P 500 because it's moderate. It does have a component of fixed income in there, which will not perform as well as equities. So knowing that, we understand that if the market was up 25%, this portfolio being 14 is not bad. But is it the best we could do? That's how we're going to compare this portfolio with a well-engineered portfolio, taking into consideration wealth enhancement. Now, again, you've got 3 different tax statuses, 3 different registrations with these portfolios. What we're going to do is change up where the risk is on each one of these portfolios. How would we do that? Well, again, if your Roth account is your most valuable account, we really want that to grow the fastest. And if your IRA has the biggest tax liability, we want that one to maybe have a little bit of a governor on it so it doesn't grow as fast. Now understand, we still want that moderate rate of return that we're looking for. Now, what about the trust account, the non-qualified or tax-favored account? That one we might want to have as a moderate portfolio. So let's take a look at how that would look if we not only ran this program based on asset allocation investing, which is what all the advisors do, but also we take a very close look at asset location investing. Let me explain that. So on this next slide, if you look over on the left-hand side, you'll see that we changed the portfolio up a little bit. We added a Clark Navigator fixed income portfolio. We also added a Dana large cap all equity portfolio. The next thing we did was we changed the allocation to match the tax registration, whether we're trying to slow the growth down or whether we're trying to accelerate the growth. So let's see how we've got this played out. Now the SSGA portfolio, which we kind of like, we kept. That's going to be our moderate portfolio. And we're going to utilize this in the trust account. So this is the tax favored portfolio. Now, the next one is the Clark Navigator. The Clark Navigator, that's a fixed income portfolio. We don't expect that to go up a lot. We don't expect it to go down a lot. But we're going to utilize the IRA account in this portfolio. I really don't care if it has a lot of dividends, because no matter what, it's all going to be charged on our tax return as ordinary income because it's an IRA. Now, the third account, we're actually going to make this one more aggressive. This is the Roth account. This is the tax-free money. This is the money we want to grow as fast as we can get it to grow. So this is what we call asset location investing. Now, let's take a look again. That slide bar in the center there, the S&P. We're going to show the S&P going down 34%. What happens to the portfolio if the S&P drops 34%? Well, let's take a look at it. As a whole, the portfolio goes down 23%. But let's take a deeper dive. The SSG portfolio, moderate portfolio, just like before in this scenario, went down about 22%. That's your trust account. Now let's look at the Clark Navigator. This is your IRA account. That one, because it's now very conservative, only went down 1%. All right, but you might be saying, but that's my IRA account. Yes, it is. Stay with me here. Now the next portfolio is your large cap equity portfolio. This one went down a whole lot more because it's all equities. It's going to work more like the S&P 500. This is your Roth account. Now again, you might be thinking, yeah, but I don't want my tax-free money to go down that much. All right, work with me here, because I'm going to show you how this is actually going to be in your favor long term. So now we've stress tested the first portfolio on the negative side and the positive side. We've now stress tested the new portfolio on the negative side. Let's see how it works on the positive side. Again, let's say the S&P 500 goes up 25%. Well, your trust account, again, still a moderate portfolio, went up 16%. Okay, I like that. The Clark Navigator income portfolio, which is your IRA account, only went up 4%. Remember, this is your taxable account. The next account, the Dana large cap, this is your Roth account. This one actually went up 25%. Again, this is an all equity portfolio. Now, take a look at where the gains are coming from. And keep in mind also how many times the market goes up before it actually goes down. And I'll talk about that a little bit in the next slide. But for this, your trust account went up nicely. Okay, that's tax favored. I like that. Your IRA account, which is fully taxable, didn't go up much at all. And your Roth IRA, which is fully tax-free, actually gained 25% in that account. That's a big deal. Now, I said I would talk a little bit about the market. The reality is the stock market on average goes up 3 years for every 1 year down. So I don't mind if my Roth account goes down on 1 year if I'm gaining 3 years on the upside. because long term, it's still an aggressive portfolio. It's going to have a higher target rate of return. In this case, we're targeting an 8.5% rate of return in that portfolio, whereby my IRA account, I'm only targeting about a 3.5 to 4% rate of return. Again, that's my most dangerous account, if you will, when it comes to taxes, because it is fully taxable. Now, the other thing I want you to keep in mind is that relative to how this portfolio is working, we know that if I get these nice increases in my Roth account, I get to keep all this money. If my IRA, which is again fully taxable, is on the low side, I'm not growing that ticking time bomb, if you will, of a tax mess. I'm keeping control of it at this point. And then obviously our non-qualified account is tax favored, so that's going to be somewhere in between. So if you think about it, when we average the rate of return, the rate of return might be the same or better than that previous portfolio. But the difference is you, the client, get to keep more of the money because the growth was really focused on the tax-free or the tax-favored, not the fully taxable. Okay, let's move on. Now, I'm looking at the portfolio engines again, and now we're going to do a little bit more of an analysis on the returns. So the new portfolio that we put together, if you look at that center graph there, that's our return by strategy. It shows you that black dot, which is the portfolio we have put together, the new one that was engineered, is actually performing better than the portfolio that the client came on with. And that's that blue diamond right below it. Also, it shows you how each one of the portfolios are working from a risk return standpoint. Now, when you're looking at this portfolio, again, you can see that the average rate of return, so now we're going to go down to the bottom part of this chart that shows the current period, 3-year, 5-year, and 10-year returns. You can see your Roth account is over a 10% rate of return. That's your tax-free money that's at work for you. Then you go to the Clark Navigator. This is your taxable income. Well, that's only at about a 2.2%. Again, I'm not really concerned with that because that's my biggest tax problem right there. And then when I look at the moderate portfolio, the 10-year return there is about 5.1. When you blend all these together, the 10-year average rate of return is 7.46. Well, how does that relate to the previous portfolio? Well, this is how it looks. Again, if you look at the bottom part of the chart, the previous portfolio that we inherited, their annualized return is sitting at about 6.15%. If you look at our portfolio, the one we've engineered, that's averaging about 7.35. And again, where is most of the growth? It's in your tax-free or tax-favored account. Now, if you look at the next column over where you see the volatility, the previous portfolio, though a little bit less volatile, ultimately did not give the rate of return that the client would really need long term. So this is how we look at each one of the portfolios. If you look at the risk return chart in the center, that black dot is the overall portfolio's risk return. The blue diamond right in the crosshairs there is the old portfolio. And then when you look at the 3 dots, the other dots, you've got one on the left side, that's your IRA, performance and risk. The one closest to the center mark there is your trust account. And then the one that's over on the upper right side of the chart is the Roth account. So we can actually analyze each one of the portfolios, see how they work in relationship with each other, and compare it to other portfolios to see what is going to work best for our client. So that brings us back to this slide, the wealth management part of this. We've got a lot of tools that we bring to bear for our clients to get them the best long-term net rate of return that they can get. I've said this many times, Rocky has said it many times. You know, getting a good rate of return is important. There's no question about that. But the advanced planning is what takes it to the next level. The advanced planning is what allows you to keep the money in your pocket. So that takes us to the next slide. Again, we've talked about the discovery meetings. We've talked about the investment strategy meetings. We've taken a deep dive into the portfolio development. From there, what happens? Well, then we have to implement. Now we're going to implement the new portfolio. We're either going to dollar cost average if the stock market's a little on the choppy side, or if we're in a full bull market, we might go all in, or some kind of variation of the two. But we want to get into the market in the new portfolio as soon as possible. The next step is the portfolio management throughout the years. We want to make sure we're constantly rebalancing this portfolio back to target to make sure that the downside threshold that we've determined in the investment strategy meeting will not be breached. So that's all done internally as we're working through the process. Next is the review meetings. When we get into the review meetings, we might find life changes that go on. It could be that you're looking to buy a new house, move from one state to another. Could be that you've got someone going to college. Could be an illness or a death in the family. Well, this may take us right back on this continuum to the discovery meeting and then the investment strategy, portfolio development, and so on. Something else we say here a lot at Daniel Krug and Associates. We are tactical wealth managers. We not only do tactical when it comes to the way the investments are put together, but we're tactical in every aspect of what we do, whether it be the investment consulting, or it's the tax management, or it's the estate planning, or possibly the protection. In other words, liability. How do we protect from any kind of liability we might have out there? So for our firm, we're tactically managed in every aspect. And we believe that the way today is moving so fast, if you do not have a wealth management firm that is tactically managing everything that's most important to you, you probably aren't getting as much out of what you're trying to accomplish in life as you could. So this is what the investment engineering is. This is what wealth management is for us. So let's kind of move forward here. Many of our clients say, well, tell me more. Where can I get additional information to view online? Well, if you just key in to your browser, Daniel Krug and Associates YouTube, and then find that link, click on it, and it'll bring up our YouTube channel. And there you can go into playlists, videos, really kind of drill down to see what type strategies you'd like to review. Now, each one of our webinars that we do are broken down into between 3 and 5 different segments. So if you have time for the whole thing, great. If you only have time for a specific section, you can drill down to that specific section. If you wanted to look at just Roth conversion strategies, you could watch a video that explains the benefit of doing Roth conversions, far beyond what you might hear in other places. So that's our YouTube channel. Just kind of click on it, like us if you will, but it's a place where you can go and get more information. So that brings us to the end. And we've said this before, we'll say it again, you know, there's no need for you to worry relative to your investments in your overall circle of wealth. You take care of your family, and we're here, we're ready, we're going to take care of you.